let's do that. All right, that's the goal today. This is the agenda. I want to introduce the growth model maturity concepts. This is a new thing. We've recently added it to the revenue architect content. So for those of you who took the course over 3 months ago, that will be new. And then we want to get comfortable with the growth model. So we're going to dive even deeper into the maturity stages there. I want to share with you how we internally calculate costs and how that affects the maturity of the organization. And I want to get some feedback from you guys. So that's the agenda that we have here. All right. We're talking about 3 stages of maturity. So for those of you who have, I'm assuming that most of you are familiar with the growth model. The growth model is basically the common points and challenges companies have as they grow. This is something that we, the Jocko, developed after observing and working with hundreds of companies, and we see some similar challenges along the way. Recently, we added maturity stages, right? Because that's another level, another angle of how companies mature in terms of how they analyze or design their growth. We've got 3 phases that we usually focus on. The phase number 1 is where you are in that scalable growth. And you focus on growing to achieve scalability. Right? You want to increase your revenue. That's the main focus. At some point, you go into sustainable or sustainability. This is how you find and try to get to that cost-efficient growth. And once you're mature, phase number 3, focus on the quality of the growth to strive for durability. So 3 growth stages. Most of us usually, when we join early stage companies, we're focusing on that scalable stage. Sustainable is that transition. And durable is the very mature companies we have in the world. So for those of you who are working for Microsoft and Snowflake and Salesforce, AWS, these very mature companies, this is where they play in that durable growth. For them, it's all about increasing the quality. Of course, these timelines change over time. So when we're talking about, and for those of you who have seen Jocko and Dave talk about the grow at all costs, for most companies up until 2021, it was almost always scalable growth. Nobody thought about sustainable growth. However, now that the market is shifting and we're getting signs from investors that we need to think of the cost elements of growth, sustainable growth is increasing, and we need to start thinking of sustainable growth even earlier than we ever did. So that's moving to the left. And to break it down, if we're talking about a factory, revenue factory, so maturity stage is scalability. It's all about production and accelerating that production process. That's in a manufacturing factory. And for us in a revenue factory, it's all about accelerating growth, means getting more revenue. Sustainability is all about efficiency. And in a manufacturing factory, like in our factory, a revenue factory, it's all about lowering costs. So at some point, you need to start, once that machine is working, you need to start cutting costs in order to become more efficient. And that durable growth, it's all about quality. Now, of course, we're looking at quality even earlier on, but towards the more mature stages, this is where we are focusing on increasing quality. And in our world of recurring revenue factories, it's all about delivering recurring impact and basically the quality of impact that we provide to our customers. So this is an intro to the stage of maturity, and now we're going to go even deeper into each one of them. And we're going to do some number crunching just to show you how this works and connect these growth stages to the mathematical model as well. Any questions until now about the growth, the maturity growth?
I have a question.
Yeah, Charlie, go ahead.
The art, and I apologize if this is in the book, but to what degree is ARR correlated to the stages of maturity? I mean, to what degree have you put an ARR number against, stage one happens between these ARR figures and stage two, if these are,
I can't put in numbers. First of all, because if we are really want to go into the details, remember each go-to-market motion has its own maturity, has its own place on the growth model, right? So you can be very mature in one place, and that go-to-market motion is you're already profitable, so you're here, but you've recently launched a new go-to-market model, and that is all only in the scalable growth.
Okay,
And now
thank you.
tying it up to numbers, I can't say. Right? We have some companies that are blitzscaling that, for them, we'll talk about what scalable growth means, but let's take the number one company right now, Wiz, right? They're almost at 100 billion ARR, and they're still at that scalable growth. For them, it's everybody wants some of our software. We don't need to care about costs right now. So again, it really changes.
All
But
right,
great.
thank you.
Yasmin, are you raising your hand or? All right, go ahead.
Yeah, I wanted to ask you, when do you start worrying about the next phase?
That's
like
a
you're
good
talking
question.
about Wiz, when should they start? When they see that it's saturating in terms of market opportunity, like their TAM
Yeah,
is
you're putting
reaching.
me on the spot. I thought about this
Sorry.
question all day. I don't have an answer yet. You will see what I'm going to present is quite early, and we just don't have an answer yet. When do we need to start thinking about this in practice? Like starting to think about profitability. This is 18 months before you go to an IPO, but what is happening with IPOs today? What does that mean? We hear some investors are telling us that we need to think about profitability even earlier than that. So I don't have a clear answer, and I can't give, like with Charlie, I can't give a number or indication of when that happens.
Thank you.
Yeah, but good question. Yeah. I was prepared, but I just don't have an answer.
Yeah. Thanks.
Cool. Let's talk about scalability. So scalability primary focuses on acquisition. This is where we focus most of our time, our resources when we're early stage. So we're focused on acquisition. So the crucial metrics revolve around pipeline, conversions, and sales metrics, such as price and the sales cycle. Now, it doesn't mean that when we are in those earlier stages, we can ignore customer success and everything what happens on the right side of the bow tie. But our goal is to cast a wide net to gauge how scalable our product is, how our go-to-market model is, and result in low retention rate. In that case, in the early stages, of course, it's okay to lose customers in those early stages. So there, our focus, just to summarize this, is on the left side. This is what we're focusing on. I'm looking at a question here. Would this be applied to all kind of industry or only SaaS? We believe that our models are relevant for everything that is B2B recurring. So as long as you have a recurring model, this should apply to you as well. If it's not the case, if it's B2C or B2B non-recurring, then some of it might, but we need to discuss the specific industry that you work for. Priscilla. All right, so when we're at this scalable growth, there are two options for us to accelerate growth. Before I talk about the first option, I just want to remind you all how, if we look at our go-to-market team or department as a system, so just like in all other systems, we have some input, we have a throughput, and we have an output. That is the system. And in our case, let's say it's sales. That's the easiest example. Our input is MQLs, and the output is signed customers, paying customers. So this is a system. Now, any system, in order to increase the output here on the right side, we can either increase the leads, the input. In the example that I will show in a second, it's going to be leads. So that's the first option. The second option is to increase throughput, is to increase this. Now, I want to share with you this example, and I'm using Excel. We're not going to do some very complicated calculations, but I just want to share with you and show you how we increase. So this is the same thing. I'm hoping that most of you know the growth model. This is the growth model only on the left side of the bow tie. We've got here the input, which are the number of visitors we have to our site. We have the throughput, and we have the output. And this output is the ARR that this unit is generating. All right, so we're having, in this case, this system, my marketing and sales team, takes 15,000 visitors to our website and convert them into 45 or almost 46 wins. That equals $826 in ARR. Now, based on what I said, let's say we want to double our output. We want to double our revenue. What are the first option that I have? What's the first option I have here? Write in the chat or come off mute, Yasmin.
Increasing input. Visitors.
All right. Yeah, exactly. Yeah, so let's increase input. I want to double the output in this system. What do I need to do?
Double the input.
All right, double the input. So let's say year 2, I want to double my ARR. I can multiply or generate 30,000 wins. And boom, I have doubled my ARR. And as Charlie already wrote, the second option is to improve conversion rate. Yeah, work on CR, conversion rates. How much do I need? Quick guess. If I have 1, 2, 3, 4, 5 conversion rate, it's not going to be that dramatic when I want to improve each one of them. So my second Yasmin, 1%. That's wishful thinking, but good guess. And thank you for participating. All right, let's say I need an absolute of 10%, sometimes even 20%. So I will improve 12 to 15. I will, and you can see here the numbers, the improvements here and the X. So this is already 30% improvement. And let's say 15 to 20. I'm at 1.7, almost there, right? 25. All right, almost 2x. So I did a bad job. I did too much improvement here. Usually, we can achieve better results by just compound improvement. And yeah, less discount, almost there, right? But this is how we play with it. This is how we model. When we engage with our customers, we do this exercise and see, okay, let's see what you would need in order to reach your targets next year. I'm actually in the process of doing this with one customer. They gave us their targets for 2025. We broke down the growth model. For them, it's left side and right side as well. And then we started to play with that. Where are you off? Where you can improve? And what will be the impact if you bring your results, your conversion rates to industry benchmark. So this is how we do scenario planning. Any questions on this? This is scalability growth, folks. This is how I focus on improving our output or growing, scalable growth, more input or better throughput.
Rowie, just from a pure semantics perspective, when you talk about improving the conversion rates across the bow tie, is that improving throughput or is it? Yeah, that is a throughput. You already shared that. Okay.
Yeah.
I retract that question.
All right. Thank you.
Sorry, quick question about improving the input, Rowie. What is the elasticity that you're observing for teams, right? Because if you keep everyone the same, like you quickly maybe find a plateau, right, in the amount of leads per rep that people can process and everything, so on, right? What do you think it's like? It's within realm of reason of saying, hey, if we double number of leads, we should process all of them and still have results. Like, do you have a gut feeling about it?
Yeah, we use the benchmark numbers, right? So we've got bench sites, and maybe Ian, Sarah, you guys can share that link. We use that link to extract benchmarks numbers. And we have that, and then we say, hey, a company of your size at your maturity stage, at your ACV should have these metrics. Let's see how we improve that. And of course, you're right. There's a limit to how much we can improve. Yeah, we generally do scenario planning here. All right, so let's see. If we are putting resources on marketing, they will be able to attract more visitors, right? And what would be the effect of that? So, yeah. Great question. Thank you. Now, what's the problem with this approach? Scalable growth?
I think the problem's not either one or two. It's
all right, but generally speaking, and for those of you who are following, all of our materials that we've published recently talk about that.
It's not in relationship to retention. We're not measuring through to retention to be able to.
I agree. That's another one, but I was
financial stability or sustainability.
All right, what does that mean, Michelle?
You are spending more than you make, right?
Yeah, fantastic, right?
Yeah.
Which is, again, sometimes it's okay if I have like all the AI companies that are now raising money, like crazy valuations, crazy rounds, like seed rounds of a few millions of dollars, and it's crazy stuff. Yeah, nobody is asking them to focus on profitability or financial stability. Most of us have, are working on a different on a different expectation from our investors, and we need to think about that. And yeah, the problem is that resources are becoming finite, and as a result, unchecked focus on scalable growth leads to unsustainable resource demands, which drives up costs, such as salary. Or in other words, everything that we're talking about improving input actually means either we need to spend more on marketing or we need to hire more people, right? So the costs just go up. And for those of you who have seen, we keep on using this because this is just fantastic explanation. So what you have here, horizontal axis is the timeline. Vertical axis is the cost of acquisition, so CAC, as a percentage of first year ARR. And when we analyzed 80 public companies, SaaS companies, including the likes of Datadog, Atlassian, Twilio, all these companies, you can see here that in the last almost 2 years, their cost of acquisition, if it was 150%, increased to 264%. So that means that for every new dollar we're adding to ARR, we're spending $2.64 to create that dollar. And this is what Michelle just said, like it's unsustainable. So scalable growth is unsustainable. I want to pause here on this. We'll get back to this when we start to analyze sustainable growth. Any questions about scalable growth? To summarize, scalable, early stage, focus on either improving input or throughput, and we don't look at cost at all. But at some point, we need to mature and move on to the next phase, which is sustainable growth. If we don't do it ourselves, our investors will tell us to do that. And this is the next phase of the maturity. So the sustainability builds upon scalability by integrating efficiency. And efficiency is another way of saying costs. So enhancing cost efficiency in a factory corresponds to reducing costs. Those sustainable growth balances between velocity, so how fast I'm growing, with resource optimization, ensuring long-term viability without extending the business's capabilities. Or if I need to put that in a formula, sustainable equals scalable growth, but also a function of costs. Yes, I'll be happy to share the Excel at the end of the presentation. All right, so coming back to the systems, inputs, outputs, it's the same thing, but we're just adding now the cost element, both how much it costs us to generate more input or how much it costs us to improve the throughput. So for the sake, we're going to go back into the Excel in just a few minutes, but I just want to lay how we are calculating costs. When we measure a client's cost, we usually look at the unit economics. And we want to break it down. And for simplicity's sake, here I'm taking marketing, BDR, and AE. This is an economic unit or independent unit. And I want to measure each one of their performance to generate just $1 of ARR. So in this case, and this will be will get us ready to go and talk about and see that in Excel. Marketing cost, the most common thing to measure is the cost of MQL. This is already being calculated. This is how marketing qualifies their cost. And in our case, that we will see in a second, it costs $25 per MQL. When we look at the BDR team has a OTE, salary and compensation, of $60,000 a year. And when we're looking at the AE, same thing. They're responsible to take a qualified lead and turn that into a signed contract. And their salary is $150,000. On the right side, we're going to do the same analysis. So onboarder, we have an onboarder and her salary is $100K because she's technical. And her capacity is to onboard 40 accounts a month or a total of 480 a year. Customer success manager, she manages 20 accounts. That's her book of 200 accounts. That's her book of business. And she earns $120,000. And the account manager makes $180,000 and she manages 150 accounts. And if you do the math, 180,000 divided by 150 accounts that she manages, we're going to allocate $1,200 per each account. Any questions on this? Yeah, onboarders, you have technical companies that have technical onboarders, like architects, deployment people, trainers, all these people. Yeah, I don't mind the numbers. I picked the numbers just to make it easier on us to do the calculations later. All right. And in this case, if we agree that this is like the teams that are involved here in this simplified case, I'm measuring only salaries. There are different ways if we all also want to calculate the computer and the desk and everything else that can be attributed to the cost of the sales team, etc. But anyway, these are the two. This is how we're going to do that, and we're going to simplify. Just look at salaries. On the left side, a team acquires one cohort per period. So the numbers that we'll see on the left side equals everything that this team of marketing, one BDR and one AE generated. On the right side, we have one team that serves multiple cohorts, right? Because their book of business is larger, 150 accounts. That's a book of business. So they can manage multiple cohorts. Any questions on this before we go back to the Excel? And now what I'm going to show you is how we calculate costs. To what degree is possible to look at unit economics by GTM motion? I think so. If you have the separate teams, Charlie, then you will be able to do that, pair go-to-market motion, SDRs, AE. The only thing is usually marketing. It is difficult to allocate what is the self-serve and what is the how much to cost to to enterprise and where it originated from. This is where I tell the customers in a lot of cases, and don't quote me on this, but it's true, we don't need to have accurate data to allocate cost exactly to where it originated from, as long as we are consistent in how we measure this. And if you guys remember, we focus on trends. That's more important than the actual number itself. The trend, when we have a baseline and we start to see if we're trending up or down, this gives us an indication of what we need to focus on. All right, so back to the Excel. Yeah, we're going to talk about GTM efficiency later on. All right, so what we have here, I'm just looking again at the left side of the bow tie. Different numbers, but the same process, right? I changed the number just to make them easier for us. And you can see here, this is how I calculated the cost of this unit economic, right? So we've got MQL, $25 to generate one MQL, and the cost, they're generating 4,000 MQLs, and the cost to generate 4,000 MQLs is 4,000 multiplied by 25, which is $100,000. This is how much it costs us to generate those leads. SDR, for the sake of simplicity, they have a base and variable, but in this situation, they both managed 100% of their quota. So I'm giving them full commission. So this is their OTE, and they're getting full OTE here. And when I summarize all three, I get $310,000. This is the cost of this unit. And of course, it's simplified because we have just one person. You and your teams, you have multiple people, but you just need to sum their salaries up. And this is where it gets started, this number. What is this cost as a percentage of the ARR that they are generating? In this case, it's 41%. This unit costs me, when I'm thinking factory, it costs me $310,000 to generate $748,500. Gut
Can you
feeling.
repeat?
Yeah.
So what was the cost to generate 400 or 700,000 again?
Here, 310.
Okay, got it.
Gut feeling, is this a good number or a bad number?
depends on the other side of the bow tie.
All right, that's a good one. Yeah. Charlie, you think it's bad? I don't know.
I mean, is this sustainable? I guess, you know, if you look at 310 thousand to create 700,000, this is just your sales and marketing. Is there other, I guess you start to look at CAC payback. And I know CAC payback and go-to-market efficiency are similar, but, you know, I was just thinking if that leads to an unsustainable CAC payback.
Yeah, CAC payback is what? This is 1 year revenue. It's
Oh, 6 months. Okay, well, no, that's good.
yeah,
I retract
that's
that.
Dave said. I would buy that for my company if I will. Yeah, I think it's good. Remember, most companies, the successful ones, is 264%, and we're talking about 41% here. Now, this was the good old times. But what happened? So this is 2021. You remember that for those of you who've heard some of our recent webinars, we're talking about the fact that all the numbers dropped. You guys all experienced that. And when you're looking in that siloed approach, it just dropped by a bit. So marketing is generating only, instead of 50,000, only 45,000 visitors. And the conversion rate dropped by 1%. And CR2 dropped by 1%, CR3 dropped by 6%. You see where I'm going with this? We're giving a bit more discount. This unit economics, when in 2022, when times were harder, generated same team, same structure, same go-to-market motion. Instead of generating 748, generated 400,000. It's almost half. And what about their salaries? Almost stayed the same. Right? The only thing is the variable cost, because they haven't hit their targets. So their salaries are a bit lower, but not that dramatic. I'm still paying roughly the same numbers in terms of costs. I'm paying almost the same cost and generating almost half the ARR. This is starting to be alarming. $62 is still a fantastic number, but yeah, it's more difficult to show what really happened here when companies drop their ARR, but costs remain the same. And this is the reason we've all seen this. Right? So a new ARR, this is new ARR. That's what so the denominator dropped by half and the nominator increased dramatically. And that's why we went from something that we can argue about if 150 is okay, to 264, which is, of course, very problematic. Any questions on this? Now, what we also experienced in the last few years is that our salaries became much higher than they used to. So what you can see here, for those of you, this is taken from the book. The different go-to-market motions. This is the analysis that we did on like general costs. To generate, compared to 2018, this is the cost to generate new leads, and this is the salaries that I need to pay to the sales team. And you can see mostly the cost of leads, but also the salaries increased dramatically. Now, usually at this point, I get asked, Why is this new, right? Why, as Yasmin and Charlie are asking me, like, do you have numbers and benchmark numbers? Why? Because up until recently, nobody cared about the cost elements. It was all about grow at all costs. And let me ask you this, how many of you have cost elements in their KPIs? Yeah, if you can raise your hand. Also, for those of you who are off camera, if you're just the virtual hand, I'm interested to know, because that's a conversation that I'm having. Do sales leader have some cost? All right, that's one. iPad 266. Sorry, I didn't capture your name. Okay, Max. It sometimes we do see that as cost of acquisition. And you can say that headcount is some sort of cost element. But usually we as leaders or the KPIs that we get and the targets is only on the top line. How much revenue are we generating? How many new customers are we generating? What's the retention churn rate? And nobody really tracks our costs and the efficiency of the team. So coming back to Charlie's question, what about GTM efficiency? GTM efficiency, for those of you who have followed again on LinkedIn or joined our webinars, it's not a new metric, but it is a very good metric, and we adopted it, and we want to talk about this. So GTM efficiency is all your spend and marketing spend divided by net new ARR. So it's a 264. That's the GTM efficiency. It's a great metrics to follow, but I prefer the detailed way I shared with you, because this tells us if we're good or bad. We don't know how to take action on that. It's one of those metrics that are too high level, such as LTV to CAC ratio, such as rule of 40, such as these metrics that may be good to evaluate if you're in the right stage or not. So that is why I showed you the Excel, so you guys will be able to calculate the details and pinpoint where exactly the costs are too high. And again, I want to connect that. This is the GTM efficiency. This is how unsustainable companies have become. And it's not that they changed anything, it's the market, it's the external factors that changed for them. And all of a sudden, acquiring new customers has become unsustainable for a lot of companies. We believe that 100%, so every dollar you put in, you get back the cost of acquisition to the first year ARR. So yeah, CAC payback is 1 year, but you can see here these companies have much higher LTV to CAC ratio or GTM efficiency. Now, before that, let me just show the other part, and we won't go too much into the details here. But let's say I want to add the right side of the bow tie. So adding the right side of the bow tie, this is the growth formula that I'm assuming you all know. So we have here the start ARR and the LTV, the cumulative ARR that we're getting. So 282.6. These are the same numbers that we saw earlier. This is the lifetime value over 5 years. And if I want to add the cost of the right side, this is how I do that as well. So sales and marketing, which we already calculated, there it was 310. Here but it should be the same number. The onboarding that takes place only in the first year, and then we have both a customer success manager and account manager, and they have cost every year to serve. So if I take all the first year costs equals to 349,000, which is 46% of the new ARR. And this is, I'll keep on calculating this for each year. And of course, I don't have sales and onboarding, I just have customer success and account management. So over a lifetime of 5 years, the cost here for this company or this unit equals almost 15%. That's a healthy number. And the cost of acquisition and the cost to serve, we believe should be within 15 to 25% range. And I added we believe because we're just introducing this approach and we want to validate that this is the right numbers. So this is one thing that we're launching, and we're hoping to see if it really sticks. We believe that good companies are within that range, and companies that are struggling are above that 25%. So it's like cost of acquisition and cost to serve to lifetime value.
So Roy, that's combined cost of acquisition and cost to serve.
Yes.
As a percentage of net new ARR.
Yes.
First year. Great, thank you.
Sorry, not net new ARR,
Or,
combined ARR. So lifetime ARR.
oh, of lifetime, got it, okay.
Yeah. So this is sustainable growth. Again, sustainable growth is a function of velocity and costs. Any questions? And the last one is the easiest one, actually. So the last one is durability. And durability is where we want to produce high quality products. And customers are inclined to want to buy more of them. And in the software world, this is unchanged from any factory. And we want to achieve that impact. So quality equals impact. If we have achieved that impact, that means that we're going to reach that durability. So we're doing the same thing. We're building on sustainability, but also want to measure the impact that is in a recurring way. So a recurring impact. And this one is really simple. The way to measure durability is to look at your GRR. And GRR is retention rate. And we want to see that we're above these numbers. When we're talking about durability, think of can the company continue to exist if we take out sales and marketing teams? Will the company be able to continue to grow? Is the quality of what they provide good enough for the customers to organically want to buy more? And when we think about durability, again, it's like AWS. If we pull out the sales team of AWS and the marketing team, will AWS continue to sell more? And the answer is yes, because they're a durable company. They provide impact, and they will continue to grow, sorry. Questions about durability? Again, it's the easiest one. We don't need Excel to define that. This is our classical GRR metric, our retention metric. All right. The last thing is the performance or operating metric. So in the scalable growth, different stages, I want to measure different metrics or add additional metrics, right? As we grow, we add more metrics. We don't lose any of those metrics. When I'm in that scalable growth, I measure the growth rate, because that's the number one priority, which is based on ARR, which is a combination of ACV and deals, which ACV is a function of pricing and packaging and the number of and the amount of discount that we give. And the deals is connected to the number of leads that we're generating. And when I'm looking at sustainable growth, I'm adding CAC payback period, which is a function of cost of acquisition, which is the cost of campaign salaries and leads. And actually, I also need to add here cost to serve, which I just realized that I don't have here. But we also need the cost to serve, as we talked about that, and the salaries of these teams. And when we're looking at durable growth, we're just adding the NRR, which is a function of expansion, and GRR, which is a function of seats and usage and general. So these are the metrics that we want to measure for the different stages. And then, of course, there are many other metrics, the bow tie metrics, but in general, the high level metrics, these are the ones that we want to measure at each stage.
So can you just go into measure these at each stage? Can you remind me, are these the maturity stages or?
Yes. Yeah.
Okay.
Yeah. I know it might be a bit misleading. We might want to change the name stage of maturity, right? Maturity stages. So these are the 3 stages of maturity. That is it. What questions do we have?
So Roy, I asked earlier about, is it technically or is it defendable to look at go-to-market efficiency by go-to-market motion? So do we want to look at, is it technically feasible, not technically feasible, is it defendable to look at, here's your go-to-market efficiency for your mid-market, here's your go-to-market efficiency for self-serve, here's your go-to-market efficiency for enterprise, here's your go-to-market efficiency for dedicated touch.
Yeah.
I don't know if that's, I haven't tried to do it and I haven't tried to defend it, so I'm not sure to what degree.
I think it's reasonable, right? If we consider each GTM motion to be its own production line, it's reasonable to measure that.
Okay, good.
However, again, and I'm going against Dave and Jaco from my team, I think GTM efficiency is a great number to compare yourself and to see where you are, but it does not help us as operators to understand where and how I can and should improve. And that's why we went to the Excel to actually measure the salaries and measure how much it costs, not as a, let's take from finance our sales and marketing spend and divide that by the ARR, or vice versa. I see a question here from Raul. How early do you consider scalable stage? What happens before that in terms of models and numbers to track? Before the first stage, usually, so it comes back to our growth model, and our growth model, and let me just find that. The growth model, we usually start to measure when you have that product market fit, so around 1 million, right? And 1 million, this is where you go to investors, Series A investors with 1 million, which usually indicates that you found some sort of product market fit, and then you start to scale. So you raise that Series A in order to scale those operations. Yeah. Any additional questions?
I have one more. Sorry to be so high
Right.
maintenance. The top line, the podcast had a session on go-to-market efficiency that dropped yesterday, and Sam Jacobs reached out to Jocko about it, and one of the questions was from all the moderators who aren't really experienced with this and haven't. But yeah, I don't even know if they've all taken revenue architecture, but Jocko's response to Sam Jacobs was one of the ways to improve go-to-market efficiency was to reduce discounting. And is there? I mean, I like your answer here regarding looking at the sales and marketing cost and what you're, how much cost are you putting into your throughput, but is there something regarding discounting that plays an kind of an oversized role in go-to-market efficiency? I was surprised by that answer. Maybe it could be hearsay, and it could be just kind of it's hearsay and it wasn't appropriately received.
Yeah, no, it's still right, because when you think about go-to-market efficiency, the denominator is net new ARR. And the quickest and easiest way to improve ARR is to lower the amount of discounts that we provide. And if you do that, this will be higher, and then this number would be lower, because you're increasing the denominator, and GTM efficiency will increase.
Okay. All right. Thanks.
But yeah. Yeah, that's right. Yeah, we recently, Neve, I think even since when you did that, we started to incorporate discounting. You did the revenue architects course, I mean. We started to incorporate discounting as part of the growth model, which was sometimes there, sometimes not. So we streamlined that, and discount is definitely a conversion rate within the growth model. So that's also something we recently standardized.
Good. Okay. Thank you.
All right. That's all I've got for you folks. I will share the Ian, will we follow up with an email, or you know what? I can just share it now in the links.
Yes,
So-
we will.
What's that? Sorry.
We'll follow up with an email to everyone who registered with the recording, so that you can watch if you missed anything.
All right, and I also share the Excel. If you if you want to use that, you would need to make a local copy. I have got a few tabs open there. I'll clean it up in just a few seconds. That's it, guys. Thank you very much. I hope you enjoyed this.